Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Thank you, Ashley. We appreciate the opportunity to be here, and Chad and I are going to go through this workshop here, and we're going to try and make this as informative as possible for everybody on here. I'll start with a quick introduction of myself, and then Chad will do a brief introduction as well. I have been in the insurance business now for over 30 years, writing community associations in Florida. I started out in 1993 as an independent agent. I merged with Assured Partners in 2019, and Assured Partners is a $3 billion privately owned firm. We have over 3,000 communities in Florida alone, and writing condos, HOAs, co-ops is our very deep specialty here in Florida. We're delighted to be here today. And Chad, why don't you do an introduction of yourself?
Sure. So my name is Chad Tiernan. I am a member on Paul's team. I'm also a licensed insurance agent with Assured Partners. I've been in the industry for a little over a year and a half, and doing a similar thing, specializing in working with community associations. So working with condos and HOAs in all throughout Florida. And yeah, just looking forward to the rest of the call, just to hopefully talk about the market and what's going on.
Yep, things are getting better.
So just a quick agenda. We're going to go over some association insurance basics, state of the market update, a slide about exclusions and warrants, some roof age and mandatory replacement info, some info on electrical panel replacement, Palm Beach flood map changes, which is going to be coming up in December, what to expect for 2025, what can be done to reduce rates, insurance legislation, and how to communicate and plan for increases. And then at the end, we'll have a brief time for questions and answers. So association insurance basics. What insurance must an association carry? And can they be self-insured? So generally, the insurance that a lot of associations are going to carry is always a directors and officers policy, general liability, crime, umbrella is very common. If you have property, then property insurance, including wind coverage. Those are kind of the general main ones. And then self-insured, we do have another slide on that, so we're going to talk about that in a couple slides. I don't know if you want to add anything to that, Paul, if there's any other policies.
Yeah, there's just, Chad covered the basic policies that everybody sees. Property that covers windstorm and liability for slip and falls. D&O, directors and officers, is really management malpractice coverage. So, but yeah, those are the standard and umbrella policy that covers catastrophic losses. And we will get into the self-insurance because that comes up a lot. People want to know, especially with rates having skyrocketed over the last couple of years. People want to know how to self-insure. And the good news is we're going to get into what's happening in the marketplace, and things are improving. So hopefully we'll cover a lot of that here.
So what is the role of an insurance agent? The main role of your insurance agent is really to go out to the market and get you the best possible options, as many options as they can get, and then help you work through a buying decision. So really, they're trying to help educate you on what's going on in the market, on top of that, and just help you make the best decision possible is really the main role.
Mm-hmm. Yeah, your agent is your greatest advocate. Your agent is not somebody that is representing the insurance company and giving you a bid like another vendor would do. The agent is third party, not tied to any of the companies. And the greatest value that an agent has to you is their contact, his or her contacts in the market, their knowledge of community associations and knowing what you need, and being able to explain this to you, because insurance is very complicated. So your agent really should be your advocate and should be able to explain things to you and should have the resources and the relationships with the correct carriers that are in the marketplace, so that the agent is bringing you options and the very best deal, and help you, as Chad said, make that buying decision, because those are the greatest values that an agent has to a community association.
And then, Paul, do you want to go ahead and talk about how is association insurance shopped or bid out?
Yeah, very misunderstood, because many people think, as I said a minute ago, that an agent is going to give you a price and they're the insurance company. They're not. An agent's role is to go out there and contact the insurance companies, send in a submission that has the information that the insurance company evaluates to give the association a quote or not give the association a quote. And what the greatest misunderstanding about this is how the insurance companies that would be interested in bidding in the market are only going to deal with one insurance agent at a time. So when an association goes out and calls multiple insurance agents, if you're calling insurance agents that are connected in the market, we're all going to go to the same places, because it is still fairly limited. And that's not the best way to go about this. Some people perceive that as it's really a monopoly. Well, it's not. You just need to understand how this process works, and you need to understand that choosing an agent is an important decision. And when you choose that agent, you let that agent go to the marketplace and access all the carriers. And as I said, be that advocate for you, because that's the greatest value. And otherwise you're really missing out on an opportunity to get as much value as you can from the relationship.
And so the next question is a pretty important one. How does the association know they're getting the best deal available to them? And I think this kind of ties back into that idea of, you need to pick someone that you trust is going to do the best possible job for the community. Because at the end of the day, you need to have somebody that you trust is going to go out and go to every available market and do the best job that they can do. And one thing that we do that kind of shows that we went to whatever markets we had is we have a marketing log where we'll show the exact result of each market we went to, and if they quoted, what price did they quote at, and if they declined, why did they decline? So that's one type of thing that you can do to know that you're getting the best possible deal. So I would definitely ask your agent if there's anything like that they do, and if they can provide that, because a lot of agents do that.
That's a great point, Chad. And really, how do you know you're getting the best deal? Transparency. As Chad said, you're going to see a marketing log. You're going to see all those carriers that were approached, and hopefully, because things are getting a lot better, you're going to see multiple quotes, and then your agent's going to help you make that buying decision. They're going to say to you, hey, here's option A, and here's the good things about option A, and here's the bad things about option A, and here's option B. And helping you make that buying decision is somebody that can navigate this for you is really important.
Yeah. And so the next question, what is the difference between an admitted and non-admitted carrier? So an admitted carrier in Florida is a carrier that's backed by FIGA, which is the Florida Insurance Guarantee Association. And basically all the admitted carriers are essentially backed by the state to a certain amount of money. It's $250,000 per unit. So having an admitted carrier versus a non-admitted carrier is a huge advantage, because you have that backing. So it's kind of an extra layer of security. And ideally, you would want to go with an admitted carrier because of that. If you want to add anything else, Paul?
I mean, you can't always get an admitted carrier, but as Chad says, in an ideal situation, you will. In addition to the financial guarantee that the state provides, there's also the higher degree of regulation. Admitted carriers are held to a higher standard of regulatory forms, rates. All of those things have to be approved, where non-admitted carriers really are there as a backup, and they don't have the highest degree of regulation, because the state's trying to ensure that there is a market and that there are options. So whenever you have that admitted option, but again, and going back to the role of an agent, the role of an agent is to explain all this and make sure you understand what's in your program.
Right. So this is a slide on self-insurance. We mentioned that we were going to talk about that. So Paul, do you want to go through self-insurance and how it even is possible?
Yeah, so it comes up a lot, and with the past couple years, property rates, predominantly property rates, have just skyrocketed, and many people said, we're paying this ridiculous premium, and we don't want to do this. We're just going to self-insure. And in simple layman's terms, it's not been practical, primarily because of a couple of reasons. Most notable is anybody that has a mortgage inside of a condominium association, they're relying on the property insurance to secure that loan. So you're not going to be able to secure a loan without insurance, without property insurance. Secondly, generally bylaws in every association that I've seen has a requirement that the board buy insurance. And if the board did not buy insurance and there was a loss that could have been insured, it puts a lot of risk on the directors, which really doesn't seem to make sense. And I think the good news now is we're past that crazy period of time where rates just went crazy, and the insurance market has been been returning to some sense of normalcy. Not as fast as we'd like, but a lot faster than I thought it would. So we're seeing less and less of that come up because many associations now are seeing a reduction in their cost of insurance when they go to renew. And the other issue on this slide is property insurance in terms of the full value. When I say full value on that slide, we mean replacement value. So if your condominium building is worth, let's just pick around numbers, $10 million as a replacement value, the association is required to do an insurance appraisal every 3 years to ensure the adequacy of the insurance that you're buying. We're seeing insurance companies have put a heightened level of emphasis on adequate insurance. We're seeing lenders putting a higher emphasis on making sure insurance is adequate, all in the wake of the Surfside collapse. So it's been a couple of years now, and we're seeing that a lot of associations not only have seen a big increase in rates, it's been compounded by inadequate limits now being forced to the forefront, and an association having to insure properly the buildings. So, but again, things are getting better, so we're moving in the right direction.
So to talk about that, quick kind of state of the market update. Our increase is starting to slow down. Yes, absolutely. As we've kind of alluded to, we've really turned a corner toward the end part of 2024 here, and things are a lot better than they were. We're starting to see increases slow down dramatically, but we're also starting to see a lot of flat renewals, and then in some cases we're seeing decreases. We've seen decreases anywhere from 20 to 30% to all the way up to 60+%. But that's obviously a extreme example, and that property rate was just through the roof, very inflated, and they had gotten a new roof, which helped a lot. So yes, we're seeing increases slow down dramatically, and flat renewals are very common as well.
And there's a lot of variables that go into the rate. And as Chad said, you can see on an extreme case a 60% decrease. But people ask us all the time, especially now with budget season upon us, what do we budget for next year? And in most cases, and we have some metrics that we look at for clients, but in this setting where we don't really know, we're talking to a broad base of people here. I would say at a worst case scenario, rates cost are going to be flat to maybe a slight uptick. Worst case scenario. Best case scenario, we could be seeing 20-30% decreases over last year. And in the extreme cases where new roofs and things like that have dramatically changed, even more.
Yeah, and one of the next questions was, are more carriers entering the market? And I think that's a big reason also why we're seeing some of this, because there have been a couple carriers enter the property market. And this has put a little more pressure on some of the existing carriers to compete. So that's definitely another reason why the market has improved. What impact will the 2024 hurricane season have on rates in 2025? Early reports that we've seen so far are that we're still kind of heading in that same direction. Things are still looking optimistic. A lot of that damage, in some cases, was flood damage, so it doesn't necessarily have as large of an impact on the property market. And that's because flood is run through FEMA, through the National Flood Insurance Program. So that was one thing to note for that. Paul, do you want to talk about any other sort of impact it might have?
You hit the nail on the head there. I mean, FEMA is highly subsidized, and it does not have as great an impact, particularly the Helene event. But Milton did have some wind, and we had the tornadoes and that much. So I think all indications are it's a little early to tell yet, but it is we are still hopeful things are going to stay on the path that we're on.
And then are other lines besides property being impacted? How about directors and officers, liability, and umbrella? Paul, do you want to talk about how are those markets looking?
Yeah, I mean, fortunately, if we're talking to an audience of condo associations, the big premium driver is property, but liability does drive rates, and it does drive rates for HOAs. And something called social inflation has had an impact on costs, which social inflation is the cost to settle these claims has risen dramatically. So we're not in the greatest of environment there, but it's not going to drive costs that much because it's primarily property for condos. So anything associations can do to prevent claims from happening goes a long way in your ability to acquire a quality insurance company, quality insurance policy with very few limitations.
And then the next question, are deductible options improving? This is something that's been coming up recently where we have seen wind deductible options improve. In the past, we've been seeing mostly 7.5% or 5%. But there are certain cases where we've seen 2% and 3% now, depending on the carrier. 5% is probably still the most common, but just good news that we are starting to see some of those options. And just the market is moving in the right direction as we're talking about, and that's just evidence of that. And then how has premium financing been impacted by high interest rates? Paul, do you want to talk about this one?
Yeah. When you look at some of these premiums and then you look at the cost to finance it, it can be a big number. So it's a direct component of prime rate and LIBOR. So that has gone up. At least it has not continued to rise. So I think we've hit the plateau. We've seen a decrease this year. So the other good thing about that is premium financing is assessed on unpaid balance. So the more you can put down or the fewer payments that you can make will impact the cost of the financing. So there again is an opportunity for your agent to be able to help you control the cost of financing. If you have a good agent that can be proactive there and help you, because there's not a whole lot that can be done with the rate being that it's so regulated.
Right. So exclusions, what are they and why do they matter? A couple concerning exclusions that we'll always check for on a policy to make sure that they're not on there are animal bite, assault and battery, firearms, and abuse and molestation. Those are just a few that definitely would raise concerns.
And we're talking about liability insurance here. Yeah. So we're not talking about, windstorm or anything like that. We're talking about the association's policy that you buy if there's ever an event where a third party gets injured on the premises. So
yeah.
Go ahead, Chad.
Yeah. So for example, animal bite would be if you're an HOA or a condo and you have pets that are allowed on the property, whether it's dogs or whatever the pet is. If that pet were to attack someone or another dog, and then there was a lawsuit where they pulled in the association, then, and you had an animal bite exclusion on your general liability policy, then the carrier would not cover defending you in that lawsuit. So you'd be subject to whatever losses occur from that. So these things are very costly, these lawsuits, whether it's an animal bite, assault and battery is extremely costly. That's if anyone were to get into some sort of physical altercation, firearms, if there's a shooting on your property, these things cost a lot of money to defend and can result in pretty big settlements.
Yes, they are very severe. That's why these carriers are excluding these claims, because they tend to be very severe in nature when they occur. And not having coverage. Sometimes if you have a bad claims history, there isn't a whole lot you can do. And, you know, I've said this before, I hate to sound like a broken record, but when you have an agent that understands these exclusions, can explain them to you and possibly find alternative solutions, like you can buy a standalone firearms policy, you can buy a standalone abuse and molestation policy, offering you solutions. And that's another great value of an agent that understands this space.
And so warrants is another thing that you may see on your liability policy occasionally. One of the most common ones is a swimming pool warrant, where it'll basically state that you need to have certain things in place for there to be coverage if anything were to happen to someone in a swimming pool. So you need to have a self-latching gate. You're going to need to have a sign saying if there's a lifeguard on duty or to swim at your own risk. You're going to need to have sign posted with hours generally. And those are kind of the main things, but that's a very common one that we see is the swimming pool. I don't know if there's any others that
I mean, we could spend an entire seminar on some of these controls that need to be in place. The bottom line is it comes back to knowing who you're dealing with, because your agent is the one that understands this. So many times we'll see an association that says, hey, we got this bid from this liability carrier and it's half the price. Well, there's all kinds of exclusions on it, and there's all kinds of warrants. A warrant is a condition that if it's not in existence or it's not followed, the carrier has the right to exclude coverage. So there's all kinds of pitfalls in there. And, you know, Chad mentioned the swimming pool, but there's also some on your vendors, and they put in these very burdensome, complicated risk management techniques that associations wouldn't even know how to comply with, even if they knew that it existed. Those got to be removed, and or they've got to be complied with, because they need to be dealt with. And your agent is the only one that's going to really be able to extract this and explain this to you and make sure that, well, you got a price that's half the price of what you're paying, but you're also limiting your coverage. And if you want to do that, fine, but you need to know.
Right. Yep. So roof age and mandatory replacement. Why do insurance companies care about roof age? The biggest reason why is just because if a roof comes off of a building, then there's lots more exposure to risk. And the roof obviously costs a great deal of money. So during a hurricane, if your roof is, let's say it's 18 years old, it's going to be more susceptible to getting ripped off the building than if it were a newer roof. So at the end of the day, it may not have a leak or anything. It could be a perfectly fine roof in terms of not letting through leaks. But if it's older, it's just more susceptible to being ripped off.
There's a big difference between an old roof that's functional, that doesn't leak, and one that will pass underwriting. Plaintiff attorneys for years have exploited this and put insurance companies in a box in a corner and said, well, you know, this roof was damaged by the storm. Well, it's old. And that's a big reason why insurance companies don't want to write older roofs, because they're taking on a lot more risk. They're much more susceptible to being sued. And it's very subjective. A plaintiff lawyer that wants to sue an insurance company to get a settlement can bring in their own engineers to say that the roof was damaged, but a new roof is not going to be susceptible to this, which presents a lot less risk to an insurance companies, and a lot more associations have replaced roofs. And you know, we're going to get into what you can do to lower rates, but that's the reason. And so oftentimes people confuse the fact that the roof is fine. It's, you know, it's meet its useful life, but the insurance company still will turn the association down. And the reason is because the insurance company's taking more risk, and the plaintiff attorneys know that they're going to be able to get a roof, and they don't want that risk.
Yeah, and that kind of ties into the next question. Can we be declined for insurance due to roof age? Yes, we have been talking about how the market's improved a lot, and it is still improving, but we're still in the case where if you have a very old roof, an insurance company may still decline you for it. So it is something to keep on your radar, and if your roof is getting older, to consider replacing it. Can an inspector give a report to extend the useful life of the roof? Yes, we see this a lot, where sometimes they'll ask for a roof inspection if your roof is up there in age, to show the condition of it and just make sure it's still a functional roof. So that is something where they may require that, and it could help you out in some cases. But depending on the age, they may not. They still may not write it.
All boils down to risk for the insurance company, and we're going to get into, you know, what you can do and what the differences are, but that really boils down to risk to them.
Mm-hmm. And then what should we do if we get canceled due to roof age? Paul, do you have any thoughts on this one?
Yeah, you know, most of them, when you get canceled and you're trying to go out there and acquire a new policy, you're going to have very few options. Most of the associations that we have seen in this situation have recognized that their roofs have come to an end of their useful life, and have replaced them, and have given themselves a lot more options now in the market. So instead of being stuck with one carrier, and you're stuck with what they offer you, you're gonna have multiple options. Should you not decide to replace that roof, you'll likely either not buy wind insurance, because the coverage that you will get for an old roof is going to be so limiting, it's probably not worth it. Which the consequences of that are, you're taking a lot more risk. If there is a loss, what your bylaws say that you should do and what you do are different. You might want to seek legal advice on that. But not replacing the roof will limit what you can buy, the cost of it, and the terms that you can acquire from the market.
Right. So do all carriers look at roof age the same? No. Each carrier has their own set of underwriting guidelines, and they'll look at multiple aspects of the building differently. Roof is one of them. Roof age is one of them. Some carriers, they just each have their own set. In some cases, it may be less than 20 years. In some cases, it may be less than 25 years. And another thing to keep into account is different types of roofs have different useful lives. So the carriers are going to look at it that way, where there could be a shingle roof that maybe they say it has to be less than 15 years old, versus a concrete or clay tile roof, and maybe they say it's 25 years old for a lot of carriers, or a metal roof where 30 or less. So the different type of roof plays a big role into this too, and carriers kind of all look at it in their own way. So electrical panel replacement, this is something that's come up over the past several months, really. There's certain brands of electrical panels that basically have just been deemed unsafe, and they need to be replaced. And many insurance carriers have taken notice of this and are doing inspections and requiring you to replace them if you do have these in place. So the main ones are FPE, Stab Lock, and these were put in place between 1950 and 1980. And then Zinsco, which was popular in the 1970s. And this brand was actually rebranded to Sylvania, or GTE Sylvania. So both of these types of panels can cause electrical fires and lead to serious injury and damage. If your building was built during the above time frames, we really urge you to check for your electrical panels and see if you have these brands. And if you do, take measures to get them replaced, because it's become a big issue, and some carriers might non-renew you for it if they do an inspection.
The only thing I'll add to that is that if this isn't becoming a discussion with your agent, I can almost guarantee you that the insurance companies are asking. And depending on what your agent tells them, if a lot of carriers now, and we're talking about all aspects of the insurance, not just fire insurance for the building, we're talking about liability insurance, bodily injury. This is a life safety issue. So the liability carriers are putting warrants in the policy that say that if any of these panels exist, we're not covering you. And you'll find out when this at the wrong time. And again, goes back to your agent being your advocate and making sure that that questions are answered accurately, and that you're not buying a bill of goods and you're going to find out that you're not covered for something when it's too late.
Right. Yeah. So this is a slide on Palm Beach County's flood map changes. Back in July, we had Broward County where their flood maps changed, and now Palm Beach County is changing theirs. This is going to be effective December 20th, 2024, so in a couple weeks now. And up on the slide, you can see on the left side are all of the affected areas throughout Palm Beach County. And as you can see, it's a lot of areas across the county. The right figure there shows you the number of parcels that are either raised to a higher elevation and put in a special flood hazard area, or lowered. And as you can see, far more are being raised to a special flood hazard area. That number there, the 16,000 parcels, equates to about 67% of the parcels in the county. So this is something where if you haven't heard from your agent about the flood map changing, and if you could be affected by it, I would urge you to reach out or reach out to somebody else to see if you are going to be affected, because come December 20th, a lot of places that maybe weren't required by lenders or mortgage companies to buy flood insurance might be required. So very important to check on that.
We've experienced this here in Broward County, and basically, as Chad said, what a special hazard zone is, some going from a low hazard zone to a high hazard zone, is going to drive mortgage companies to require insurance, and those that are not compliant are going to be forced. And the bank is going to just bill the person who has the mortgage in your community. And that's going to start a snowball effect. They're going to be calling, and there is probably a requirement in your bylaws that say if you are in a special flood hazard zone that you need to buy it. So the best thing you can do at this point is just be aware of what's happening, because the lenders are going to give a very short fuse. As Chad said, there's 16,000 parcels that are affected. So if you don't know, you can reach out to Chad, and we'll be able to help you identify if there's any change coming.
Yeah. So what to expect for 2025 and beyond? Valuations have been under scrutiny, and construction costs are skyrocketing. We're still seeing new appraisals being required, and by condo statute, every 3 years, you need to have an appraisal done. Accounts are still being re-underwritten, even when they're staying with the same carrier. And then changes in terms, kind of like we talked about before, we're starting to see some options for 2% and 3% wind deductibles in some cases, but 5% is still the most common. We went over those exclusions and kind of the concerning ones that you want to check for in your liability policy, but we are still seeing those get added on, especially with non-admitted carriers. As we talked about, they have less regulation where they can kind of put some of those terms on there. The hurricane wording has returned in some cases, and this is referring to deductibles, but we're still seeing named storm wording to include tropical storms in other cases. So what this means is a little while ago, they had changed the deductible wording to named storm, where basically they're including every tropical storm during a hurricane season. So your deductible could be affected by that. But hurricane wording is much more specific, which is really ideal, and that's kind of what you want. And we're starting to see that return. And 40-year recertification reports are being requested, and roof inspections, as we touched on. We kind of already touched on the increases and all that, but Paul, is there anything else you want to add to this slide?
I mean, I would summarize this, and I think this is probably the best news in what we're here to share with you today, is that things have so dramatically improved in the last 12 months. And just to try and put that into perspective, I mean, Chad and I have just acquired a client whose agent told them to expect a 30% increase next year, and maybe that was out of touch, but we are going to probably see a decrease for this client, and I think that's just in general what's happening. You know, unless you're just your building is really super old, or there's just some insinuating circumstances that are going to pin you into a corner. And even in that case, it's probably going to be a flat premium, which is not going to increase that much, if anything. So that's what I would summarize, is things have gotten much better. If you get an insurance renewal and the price goes up 30%, something is wrong, and you should seek advice from another agent that can give you a second opinion. You don't have to engage another agent by signing a change of agent letter to get an opinion. You know, you will, once you decide that, hey, this agent is probably a better choice for us, you are going to want to engage that person and make a commitment to that agent. But there's nothing prohibiting you from making a phone call, interviewing 2-3 agents, and seeing who you think is going to do the best job for you, because ultimately that's really your job, is to make sure that you're getting the best bang for your buck, and having somebody that understands the community association space, understands the coverages, can explain them to you, has those contacts in the market, and can do that, will be a good choice for you to engage.
Yeah, I could not agree more with that. I think right now, just with how competitive the market is, that it is a good time to consider what other agents can provide. So interviewing 2 or 3 agents is a good idea right now. Paul, do you want to go over this quick co-insurance example and explain?
Sure. This is really written in insurance-ese. So I'm going to try and simplify this and just give you an example of the importance of proper insurance valuation. That's really the reason why this is up here. So, and we'll use these numbers to just kind of illustrate it in simple math. But when an insurance company puts a co-insurance requirement on a policy, they're basically protecting themselves. They're basically saying, look, we're going to require you to insure 100% of the replacement value, and we are going to determine what the replacement value is when you submit a claim. And that's not a good thing, because now it's too late. If the insurance company doesn't agree with the valuation, you'll see in this example that they have an opportunity to penalize you and not pay you as much. So if the co-insurance requirement is 100%, and the value of the property is determined to be 15 million. Now that's when they come in at the time of claim. The insurance company says it's going to cost 15 million to replace this building, but the value of the property is insured for 10 million. Okay. Now you see you're not in compliance with the co-insurance requirement of 100%, because you're not insured for 15 million. So before we even get there, you have a deductible of 5%. So you take 5% of the 10 million that you're insured for, and you come up with $500,000. The amount of the claim is $1 million. Okay, so we have $1 million of loss due to a windstorm, right? Now, here comes the co-insurance penalty. We're supposed to insure 15 million, but we only insure 10 million. So it's 66% after the penalty. Okay, so we're going to penalize the claim by 66%. We're going to apply your deductible, and without the co-insurance, you're paid $500,000. With the co-insurance penalty, you're paid $160,000. And you see there in red, you just paid a $340,000 penalty because you're not in compliance with co-insurance. So how do you avoid this? You do appraisals. Some carriers will absolutely demand that the co-insurance exists. You do an appraisal. You make sure that the values are adequate if you cannot remove the appraisal. letting the insurance company do the appraisal is like letting the IRS do your taxes. You would never do that. You always wanted a third-party independent person to do it. If you do have an appraisal and the values are adequate, you petition the insurance company to remove the penalty because you've demonstrated that you've acted in good faith and you've tried to insure this properly. And oftentimes they will do that. They will remove the coinsurance. And now they have no ability to penalize because we're all in agreement up front that the values are adequate. So hopefully that's a simple explanation of something that is really insurance ease.
Yeah. So how can we reduce rates or at least reduce increases? What building improvements can we make to bring down rates? These are some really good questions. As we've been talking about, things like a new roof can play a major role on the insurance right now. Carriers are loving to see that. And those really are some of the main communities where we've been able to make the biggest impact is the ones with a new roof. So that's a huge thing to take into account. You might have concrete restoration that needs to get done. That's something that will play a big role. Really just any improvements on the building will be beneficial from an insurance standpoint.
The milestone inspections, they're looking at those, they want to see, so the improvements that you're making, addressing those issues. But as Chad said, the single greatest driver, the single greatest impact is the roof.
And do we need to insure for full replacement value? Yes, you really should. That's going to be based on your appraisal that you should be doing every 3 years if you're a condo, based on condo statute. And what should we look for when evaluating policy options? Paul, do you want to talk about that one?
Yeah, I mean, we could do half a seminar on this and some of the things we talked about, like coinsurance, like the warrants and the things like that. And I think that having your agent knowing that what your needs are and what you want and navigating those pitfalls is worth it. It's weight in gold. And your agent should be able to explain to you, hey, this is a good option because it doesn't have a coinsurance. This is a great liability option because it's an admitted carrier and it doesn't contain, the fine print that's going to burn you when you go to submit a claim. That's what you need. And you've got to trust that that person is your advocate and is looking out for your best interest and not just delivering you the cheapest price to get a commission.
Right. So what is the state doing to help? Some of this is kind of old news that we've touched on in previous webinars, but the SB 7028 was put in place to put $200 million into funding in addition in the My Florida Safe Home program. And this is really for homeowners, so it provides grants of up to $10,000 to homeowners to make improvements, wind mitigation improvements to their home. I believe that applications have been closed on this program for quite a while. This really was, it opened up, I think, back in July. HB 1029 was a new bill that was passed to create the My Safe Florida condominium pilot program. And this would provide grants to condominium associations to make wind mitigation improvements. This was put in place in July, but it didn't really open up until earlier in November. And applications reportedly have closed. I think they closed within the first week of this opening up. So I would stay tuned in case any of this changes and they reopen it if they get more funding. But for right now, it seems like that is closed. And then there was another bill to reduce property insurance premiums by $500 million statewide through elimination of certain taxes and fees. And this is going to cover policies written for 12 months between October 1st, 2024 and September 30th, 2025. So
small in the grand scheme of things, but
exactly.
Sounds like a great thing, 500 million, but
yeah, really not a huge dent. So hopefully we can see more that the state will do. But that's just a couple things that they've been doing. And then Paul, do you want to talk about how do we kind of communicate the increases and renewals to residents?
Yeah. I mean, fortunately, I think the theme of this seminar has been things are getting a lot better. So you really hopefully aren't having to deliver increases and that, but when that was an issue, being transparent and keeping people in the loop so that they know what's coming, I think has been a really good piece of advice. Have professionals deliver the message, meaning bring your agent to the meeting. And if there's information, a lot of people in the community will blame the board for this. Have an expert there and deliver a message and be able to explain to people. An agent's making a good amount of commission and should be willing to attend meetings and do that and help you explain things to your members. And condo insurance is still a good deal. The example where you're looking at $1.7 million policy. Basically, the way we measure these rates are per $1,000 of value. Sorry, per $100 of value. So we take the replacement cost and we divide it by the premium, and we come up with a per $100 cost. And when you boil that down, generally commercial condo rates are a lot better rates per $100 than people pay for single family homes by a lot.
Yeah. So that's kind of all of the topics we had so far. And now we'll go through some of the questions and see if we can pick out some to answer while we still have some time.
Yeah, I could cover that while you look there. I'll answer the first one there from Susan about changing your effective date, and does it affect cost of policies during hurricane season. This comes up a lot, Susan, and basically you've got to go on a 12-month cycle at some point. So your carrier is going to put the wind load in for wind season. If being in the middle of hurricane season could present some issues, but generally it by canceling and rewriting a policy, you're not going to realize a savings. And when the market was hard, nobody wanted to cancel and rewrite their policy because they were going to be forfeiting lower costs as rates were going up. Now things have stabilized, so it is a little bit easier if you don't like the effective date. A lot of people don't like them because of timing of budgets and cash flow purposes and things like that. So something to discuss specifically with your agent as to how that would work.
So another question, what percentage lower premium can a condo association expect if we replaced a 20-year-old roof? This really just depends. It depends on a couple things. Depends on the carrier. It depends how many carriers you can get interested in writing it. Because if you have a couple carriers interested, that's where you really have the competition, and you're going to have them kind of bidding against each other to be able to write the business. So you could see a decrease of anywhere from maybe just 5% up to 30 or
even more,
30% or maybe even more. It really just depends.
Depends on what kind of deal you have now too.
Yeah.
We can do that. We can analyze where you are now and what that would be specifically, but you should see something on there. The next question I think is a good one. Can multiple agents, Karen asked, can multiple agents working on our renewal at the same time? So this is what we talked about before. What I think is important to understand is before you engage an agent, first of all, the agent that you have now is your agent of record. Nothing prohibits you from talking to other agents, getting some advice, seeing what this person can do, giving you a second opinion. But having multiple agents go to the marketplace at the same time doesn't do anything for you. It doesn't get you multiple bids because the marketplace is fairly limited in Florida, and we're all going to go to the same place. So the first agent in is going to have access to the market. And then if you split those markets, you're not getting any additional bids. You're just having multiple people do the same job. So the best way to go about that is find an agent that you think is going to be doing the best job for you. And if you think that agent is going to do the right job, engage that agent. If the agent that you have now is doing all the right things and you're comfortable with this person, then you should stay there.
This is a good question that definitely comes up a lot from Cheryl. How could a condominium association align the annual insurance renewal date with the association's fiscal year to be able to include updated insurance costs in their annual budget? Paul, do you want to kind of talk about this?
Yep, this was similar to the question that came up before about changing your effective date. So you know, your policy, if your policy renews with your budget year, that would probably be the ideal situation. Generally, that's going to be 1/1. Everybody renews on 1/1. All the underwriters are trying to use their vacations before they're they lose it or use it or lose it kind of a thing. And my feeling is that you're not going to get the attention that you need from underwriters to do that. So you would sacrifice that. I think the advantage of having the insurance, and I recognize that insurance in many cases is, if not the biggest expense, one of the biggest expenses. But I think the advantage of if it's off the effective date or off the anniversary date, if you get the budget number wrong, you're not going to have to absorb the entire cost of that year, because let's just say your insurance renews in June, but your budget year is in January, and you've under budgeted. Well, half of the year you're locked in at the lower rate, so it's only half the year that you have to adjust for. So I think that has some value too. You also have to be aware of penalties to cancel and rewrite if you're going to change carriers and do things like that. So that you really need the advice of your agent specifically if you are going to do that. I think we may have time for one or two more.
Yeah.
Yeah, there's a lot of questions about timing of renewals and things like that. But just remember this, that everybody, no matter when you renew, you're going to go through a 12-month cycle. So you are going to renew in the hurricane season. The best thing for the insurance company is for you to extend your policy in the non-hurricane season, because they're going to collect all the wind premium and they're not going to have any wind exposure. So you're going to find insurance companies are out there saying, hey, if you renew in December, we'll extend you to May. No problem. Because it's a great deal for them. They're taking all of your wind premium and they've got no exposure. And they put you right up against the hurricane season. So I don't know why you would want to do that. I've seen that a lot with some associations, where when rates were going up, agents were saying, hey, we're going to lock you in. But what maybe the agent didn't tell you was it's a great deal for the insurance company, because they just collected all your wind premium and didn't have any exposure.
Shirley asked, do you recommend having your roof inspected prior to the warranty expiring? Our warranty expires in 2026.
Yep. But again, warranty and roofs leaking don't correlate to the insurance company underwriting your buildings. If your roofs are old, they're going to look at that, and they're going to they're going to underwrite you based on the two risks don't correlate. Because if there's a hurricane and an association hires a public adjuster or a lawyer, and they try and force the insurance company to replace the roof, it has nothing to do with your warranty and whether your roof leaks. Want to do one more?
Yeah, sure.
Is flood insurance considered property insurance?
Yeah, that's a
good. Want to do that one?
Yeah, it's a good question.
So John asks, is flood insurance considered property insurance for 718 purposes, or any regulations? If so, is the full replacement value required? That's a great question. So flood insurance is not considered property insurance or hazard insurance, as the lenders like to, because it's an exclusion. Flood is a standard exclusion on a property policy. Property covers wind, lightning, fire. Flood is always excluded and always written primarily by the National Flood Insurance Program, which is highly subsidized by FEMA. Yes, you will need to insure them for full replacement costs. And right now, as we mentioned, lenders are looking at that. Insurance companies are looking at adequate insurance. When you do an appraisal, you will generally get a hazard or a property valuation, and you will get a flood valuation, because there are differences as to what needs to be insured. So we'd encourage you to, look at your appraisal and discuss that with your agent.
Thanks for watching. For more great educational content, click the subscribe button now.